Okay, welcome to our class today on standard costing and variance analysis. Standard costing, variance analysis. Standard costing, variance analysis. So that is what we want to look at today. Of course, we are coming to the tail end of our semester discussion. It's been good having you for our class. I've enjoyed my moments with you, and I hope you have gotten some gems of knowledge in our interaction during this period of time as we went through management accounting. So today I want us to look through on this, and of course this is just to also inform you that we need to prepare ourselves for our CAT, which is coming out very soon. So what is variance analysis? What is variance analysis? This is the process by which the total difference between the standard and the actual costs are determined to be able to get to know the analysis. That means there are standard costs. We measure them against the actual costs. And of course now the difference there is what gives us, or what we know as, the variances. So we'll be looking at the standard costs versus the actual costs, or whatever it is that we have as standards vis-a-vis the actuals, because at times some of them we're looking at them in actual quantities, standard quantities, and when we talk of standard quantities, these are predetermined quantities during the budgeting scale, things which have been, some of them scientifically been proven to be the best of the standards, like when you're mixing rice and water to be able to do yourself very nice rice meal. There's a ratio of 1 part, I think it should be 1 part of rice to 2 parts of water. So that is the standard that has been there. But there's the actual, the people who, instead of doing 1 part of rice to 2 parts of water, they even do 1 part of rice probably to 2.5 parts. I don't know whether that gives you a stewy rice or that just gives you a normal rice. So we have the standards that we are comparing against the actual, and then it yields into variance. And what's the purpose for variance analysis? The main purpose of variance analysis is to control the activities of an organization more effectively. So you can be able to know that these were the standards, or the budgeted things that we did, against some predetermined actuals that we achieved at the end of the day. So once you measure them, you can be able to plan well the activities of an organization. Of course, it highlights to management that everything is not going as per plan. If there are changes from, if there are serious changes from the standards vis-a-vis the actual, then it can be able to confirm to management that things are not working as per standards. The total difference from this particular budgeted, of course our standard cost normally gives us our budgeted profits at the end of the day. Our actual costs leads us now to the actual profit. So these parts that relate to the costs and of course the budgets and the actual that are further subdivided. And this is where we find our operating profit in terms of variance, which is the difference between the budgeted and the actual operating profit within a specific period of time. Let me try bring in some chart that will again address this very nice. Of course, when we talk about an operating profit, then we are talking about sales less costs. Sales less costs. So we can be able to look at it from a particular angle, that there are variances that relates to sales as well as variances that relates to cost as it is. The ones that relates to sales are two. Let me just highlight them down here. And so one that relates to sales, we have the sales margin price variance. So we have the sales margin margin price variance. Then we also have the sales margin quantity variance. Let me just abbreviate it: sales margin quantity variance. So we have the sales margin price. So one of them relates to the price, the other one relates to the quantity. One relates to the price, the other one relates to the quantity. Of course, we can bring again that aspect of quantity, we can break it down further. Let me just break it down here further. We can break that particular aspect of quantity where we are talking about a mix variance. And then we are also talking of a volume variance. So we have a variance in terms of the mix of the sales, then we have a variance in terms of the volume. So on sales, we have these particular variances that we can be able to look at. Then cost also has several of variances that we can also be able to look at, and we will be looking at them again briefly. So cost variance can be able to be, let me make this a little bit bigger. So I hope this other part is okay. And we are talking about our profit, operating profit, which gives us the variance is from sales minus our cost. When we subtract our sales minus cost, then we end up with our profits. And then we are saying under sales, we have our sales margin price variance in terms of the prices. Then we have a sales quantity variance in terms of the quantity. And when we talk about quantity here, we are talking about the quantity that already is there in the standard versus the quantity that is there in the actual. When we talk about the price variance, is the price as per the standard versus the price that is there in the actual when we are doing our sales. So let me just delete this so that we work on that cost, because it has several variances associated to it. Yeah, so the next one is now the cost. I said, let me just have it here. We have our profit equals to sales minus cost. Of course, we have looked at the variances associated with that. Let me pick up now the variances that are associated with cost. Of course, from that particular one, we cost is from our manufacturing account. There could be costs which are associated with production. So we have our production costs. Then we have costs that are associated with the selling and distribution. Selling and distribution. So we have what we are producing, the cost of what we are producing, and the cost of what, after we have produced, then we go ahead and sell them. We go ahead and sell them. The selling and distribution variances will just be on that particular selling and distribution costs. That is where we'll be looking at the variances, the standard vis-a-vis the actual that we have received. But there are several of them that are associated with the cost. If you remember, in our previous manufacturing class, we had a discussion on prime cost. And the prime cost had things on direct material. There was direct labor. There was what else again? We had those direct material, direct labor, and of course any other direct expenses. Then after the prime cost, then we had overhead expenses. We had overhead expenses, then we had the fixed overhead expenses. So we had direct material, direct labor, we have overhead. Of course, these ones are the ones that give us the prime cost. Then we have overhead expenses and fixed overhead expenses. Of course, some of them are now the overhead expenses, some of them could be variable now and then, others could be fixed. So we have our overhead and fixed at the end of the day that makes up the production. So on all these components that make up the production cost, we will be doing an analysis for them. We'll be doing a variance analysis for them. So you will have that under product cost. Let me just remove this part so that I have some space there. So you'll find that under product cost, we have direct wages. Let me just bring it here. Of course, there will be several of them. So one of them is the direct wages, the direct wages variance. After direct wages variance, we have direct material variance. Direct material variance. After the direct material variance, I've said we have the variable overhead, variance. The variable overhead variance. Let me abbreviate it like that. And lastly, the fixed overhead variance. The fixed overhead variance. Of course, again, they are further subdivided into a few of the components that make up wages, and wages have a component of labor, wages have a component of the rate, wages have a component of people who are idle. So this can be further, again, be subdivided into the following three components. The wage rate variance, I'm just abbreviating, but you can be able to write it in full, wage rate variance. Then we talk of labor efficiency variance, and lastly, we talk of idle time variance, So we have the wage rate variance, the labor efficiency variance, and the idle time variance. Then the direct material cost is a component of two also. We have the price, and then we have the material usage. So we have, let me just bring it here. So we have the material price variance, and then we have the material usage variance. Yeah. So we have two components, the material price variance and material usage variance. All of them are direct material variance. So we are looking at the material price variance in terms of price, then material usage variance in terms of the quantity, Of course, the material usage variance can again be subdivided into the mixture and the yield. So we are looking at if you have a material usage, we will be looking at the mixture, the mix variance, and then the yield variance. So we have that particular component, the material usage variance can be having component of a mixture variance, and then the yield variance at the end of the day. Then the variable overhead and the fixed overhead, we will be talking about expenditure variance and efficiency variance for this particular one. Let me bring it down somewhere here. So we're talking about expenditure in terms of how much we have spent. So we are having expenditure variance, and then we are having efficiency variance. So for the variable overhead, we are talking about efficiency and expenditure variance. Then for the fixed overhead, because this is where we are talking about spreading things like rent in terms of the volume, and the things that we cannot be able to associate directly with the production of one unit of a product, then again we will have something on expenditure variance, and then after expenditure variance, then we'll be looking at the volume variance. So we are talking about the expenditure variance in terms of the planned expenditure, and then again we are talking of the volume variance. And then lastly, that particular volume variance is also divided in terms of capacity variance, and again, apart from capacity variance, we're also talking about efficiency variance. So on a nutshell, you can be able to view it in a diagram like that. So we have, of course, profit, which is a component of sales minus cost. We had looked at what was making in the component of the sales variance. Then cost has all these variances, production costs, and then of course the selling and distribution variances. Production, we've said, is a component of wages, a component of direct material, a component of variable overheads, and a component of fixed overheads. Of course, you could be able to remember our discussion on the cost function, where we have this particular element which we have a fixed, then this particular part which varies, the variable costs, which changes with the amount, the cost here changes with the production in terms of the numbers of units. So we have that element of direct wages, direct material, the variable overheads, and then the fixed overhead. So with that kind of a diagram, you can be able to get to understand and appreciate the type of variances that are there. We will now delve into calculation, and we'll pick one of them which we'll be using for our class, and then you can now replicate that as we study for the other types of costs. Of course, from this chart, we can be able to identify some variances which we can basically, and some authors have derived a table like this. Some of the authors have now wrote a simplified table. And they have shared that we have, they have now divided variances in terms of price variance and quantity variance. They have divided them into those areas. Then we have these components. So we have one, the direct material. We have the direct labor. Then we have, of course, the variable overheads, and then the fixed overheads, and then they bring in the element of sales. So for direct material, we will be looking at price variance. Then again, we will be looking in terms of quantity. We will be looking at the usage, that is for the direct material. For the direct labor, we will be looking at, in terms of price, we will be looking at the rate, and then in terms of the quantity, we will be checking on efficiency. efficiency. Then on the variable overheads, in terms of the price, we will be looking at the expenditure. Again, the same thing for the fixed overheads. We will again be looking at expenditure. And then in terms of quantity, we will be looking at efficiency. And then in terms of the quantity for the fixed overhead, we will be looking at the volume. Then lastly, for the sales, of course, for the price, we will just check the price variance. And then for the quantity, we will be looking at the quantity variance. So the amount of quantity that we have used at the end of the day. So let's delve into one of them, where now we will be looking at material cost. And I think once we have done that, that again will push us to understand a number of things. And I want us, as we get to delve into that particular material cost, remember our chart. We'll bring it back again as we pick this example so that we see so we have a direct material cost variance. We had a direct material cost variance, which was a component of two things. Let me draw it here. Direct material cost variance, which was a component of two things, and one of them was the price, and the other one we say was the usage. One was the price, material price variance, then material usage variance. So then that means for you to get material cost variance, the direct material cost variance, for you to get it, it will have a component of the price variance and a component of the usage variance. So you will find the formula of direct material cost variance. It will be equals to material price variance plus material usage variance. It will be a component of these two, the material price variance and material cost variance. It will have those two elements being addressed to it. So it's something that you have to really remember, that particular part. So if I were to drop probably this one as a material cost variance, it will be a component of material price variance and another component of material usage variance. So this will be equals to this plus that. So it will be a component of those two at the end of the day. Don't mind my smileys. They are there to make me, probably make us have some little gems of understanding. So of course you will look at main causes of variance, which is for your private study. Of course someone will be able to test about that and why there are those variances. So let's pick up this example that we will use to call off our, before we call off our class. Let us pick this example. Kuman Company Limited. Kuman Company Limited engages in the production of a product named, they engage in the production of a product named Q1. They engage in the production of a product named Q1, which is packed in terms of 3 kgs. It is packed in 3 kgs. Sorry, so this is packed in so it's packed in 3 kgs, and it is costing 5 shillings per kilogram. The cost is 5 shillings per kg. the cost is 5 shillings per kg. 14,000 kilograms were used. 14,000 kilograms were used. So their actual usage is 14,000 kgs. And they spent 84,000 shillings. And they spent 84,000 shillings. After using 14,000 kilograms, spending 84,000 shillings, the units that was actually produced, so the produced units were 4,000 units. The produced units were 4,000 units. You are required to calculate the material cost variance. You are required to prepare the material cost variance. Material cost variance. And I've said direct material cost variance is a component of the material price variance and a component of material usage variance. So let's look at the first component of material price variance. Material price variance. Material price variance. So how do we calculate material price variance? Material price variance is a component and calculated by the formula actual price times the actual quantity. Actual price times the actual quantity. Then we subtract the standard price times the actual quantity. We have actual price multiplied by the actual quantity, then we subtract the standard price times the actual quantity. So whatever it is that we are looking at here, the variance that we are considering is a variance on price. It's a variance on price. So you'll see an actual price and you're seeing a standard price. But the actual quantity, which is not our calculation now, under material price variance, we are not touching it. They remain the same. It remains the same. So our actual price times actual quantity has been given to us. The actual production of 14,000 kilograms, which costed 84,000 shillings. So our actual price times the actual quantity has been given to us, and the figure is 84,000 shillings. The figure is 84,000 shillings. But we have a standard price, and the standard price that we were told is that these things are packaged in 3 kgs and it is costing 5 shillings per kg. It is costing 5 shillings per kg. The amount of the actual units they produced was 4,000. The amount of the actual unit that they produced was 4,000 shillings. Was 4,000 shillings. Was 4,000 units, sorry. Was 4,000 units. Was 4,000 units. Was 4,000 units. So, we are told the standard price is 5 shillings. The standard price is 5 shillings. And now the actual quantity produced was 14,000. The actual quantity that was produced was 14,000, and we are charging 5 shillings per kg, 14,000 kg. So if we are multiplying that with our standard price of 5 shillings per kg, so it is 5 times 14,000, 5 times 14,000. So if I do 5 times 14,000, let me just pick it up with my calc here. So we have 5 times 14,000, that is 70,000 shillings. So we have 84,000 minus 70,000. So the difference here in terms of our material price variance, the difference here is 14,000. The difference here is 14,000. So we have 14,000, and this variance can either be adverse or favorable. Adverse is where you plan to spend less, but you have spent more. That means your actual price and your standard price varies, but it varies on the negative, in the sense that you had planned to spend 70,000 shillings on the actual 14,000 units, but you spent 84,000 shillings, so you spent more. So whenever you spend more than your actual plan, then the essence there, we denote it be the word A, that stands for adverse. In terms of variance, variance can either be adverse, or a variance can either be, which is denoted by A, a variance can either be favorable, denoted by B, by F, sorry, by F. So how would have this been a favorable one? If assuming we had spent 64,000, so our actual price and actual quantity is 64,000, but what we had planned to spend in terms of our standard price could have been 5 times 14, which is 70. There'll be a difference of 6,000, and that 6,000 would be favorable. Why? Because we have actually spent less as compared to what we had initially thought of spending, more of 70,000. But our case here is an adverse, because that is 84, and that gives us 14. Remember, we are calculating material cost variance. So we have done the first part there, material price variance. We are now moving to material usage variance. Material usage variance. So like in the first case, our concept here, we are looking at the price. Now we are looking at the usage in terms of the quantities that are there. And material usage variance is given by the formula, the standard price multiply, because now we are not bothered with the price, we are only bothered with the quantity. So we have the actual quantity minus the standard quantity. The actual quantity minus the standard quantity. The actual quantity minus the standard quantity. And the actual quantity, the standard price here, we already know our standard price is 5. So we have 5 there. Our actual quantity, we have used 14,000 kilograms. That is our actual quantity. Then our standard quantity, remember, we are packaging at 3 kg. Of course, every unit is 3 kilograms. So that means if we produced 4,000 units, every unit is 3 kilograms in terms of our standards. So we multiply 3 times 4,000, then our standard quantity is 12,000 kilograms. Remember, it produced 4,000 units, and every unit is packed in 3 kg. So it's a total of, in terms of kilogram, now it is 3 kilograms times the 4,000 units. That gives us 12,000. Of course, when you now subtract that, this will be 14 minus 12,000, that is 2,000. 2,000 times 5, that would be 10,000. So material usage variance will be 10,000. Our material usage variance will be 10,000. So again, remember that this has to be given an initial, whether it's an adverse or a favorable. But you look at it here, we had planned in terms of quantity that we will be using was, if we used our standards, we could have used 12,000 kgs, but we ended up using or producing at 14,000 kgs. So that means we have overused material. Probably there could have been some wastage in the process. So this difference here again is adverse. That difference is adverse. We had planned to use less, but we have used more. So we have more material wastage than what we have anticipated in using. So our material usage variance again now is adverse, and our material price variance is adverse. So our material cost variance, our direct material cost variance, which we say is a product of material price variance plus material usage variance. So this will be a 14,000 adverse plus a 10,000 adverse, and then this would give us a 24,000 adverse. So we have a 14,000 adverse plus 10,000 adverse, that gives us into a 24,000 adverse. For purposes of just illustration how the adverse works and how the favorable works, assuming, let me just do a small illustration. Assuming, let me remove this. Assuming that our material price variance, was equals to, let's say, 10,000 adverse, then our material usage variance is 5,000, but now favorable, because we have realized that we used less units than what we had anticipated to use. So we minimize the use of materials. That means there could have been efficiency that was brought about by the materials we are using, or some new technology that again allowed us to use little material. So we had a cost savings on materials. So when we are adding the two to get us our direct material cost variance, so we have a 10,000 adverse and we are adding a 5,000 favorable. If you look at it keenly, this adverse could be connotated as a negative. So we are adding a negative, which is adverse, with a favorable, which is positive. Favorable is positive. So that means our direct material cost would be 5,000 adverse. It would be 5,000 adverse. That means we have a negative 10 plus a positive 5, that gives us a negative adverse. And supposing this was a favorable and it is 10,000 favorable, so that means that will allow us to have a negative of 10,000 plus another positive of 10,000, then it will be a nil effect. There will be a zero effect there. So we will have a negative 100 favorable adverse, and plus 100,000 favorable, then we would have a zero there. If assuming this was again 15,000 favorable and 10,000 adverse, then it would be a negative adverse and a 15,000 favorable. So that would give us a difference of 5,000, and that 5,000 would be favorable. That particular 5,000 would be favorable. So that is how we will be calculating our material cost variances, and we can pick in another example so that we can solve in our during our times of revision, so that we can be able to understand how this particular discussion now runs through. So let me give you this takeaway assignment that we'll be working with, and we are saying that Cuman Company Limited used the following material for producing product Q2. Let me just highlight a few of those things here. For producing product Q2, so human is now producing product Q2, and this Q2 has the following issues, which is 2 tons at 150 shillings per ton. So this is produced in 2 tons, each 150 shillings per ton. That product Q2 comes in 2 tons, and each is 150 shillings per ton. 11,000 tons were used, so the actual usage was 11,000 tons which were used, tons at a cost. These ones were used at a cost of 1,760,000. At a cost of 1,760,000, and it yielded the yield there. It yielded 6,000 units. It yielded 6,000 units. It yielded 6,000 units. You are required to calculate the material cost variance. Calculate material cost variance. Calculate the material cost variance. Remember, we have said that material cost variance, as you'll be working on this, is a component of 2. The direct material cost variance is a component of price and a component of the usage in terms of what we are calling in quantity. So once you will have gotten your price variance, you get your quantity variance, then you add the 2, then that will give you your direct material cost variance. That will give you your direct material cost variance. As I've indicated, as we were starting our class today, we will be preparing ourselves now for a cut that is coming up soon. So I wish that we prepare ourselves adequately, we do the revisions, and the cut will cover widely again all the topics that we have been doing right from the start up to this particular lesson. Remember, it's been glad having you. I've really appreciated being with you in this particular class, and I hope that we get ourselves prepared to do our last mile as we end our discussion on management costing, management accounting, as we prepare ourselves for the forthcoming exams. With those remarks, may our good Lord bless you, and see you off again in our next class.